Hi, my name is Heather Proctor with Camellia Capital Management, and today is our second video on the nickels future market, and specifically on the short squeeze that took place earlier this year. So in our first video, we discussed what a short squeeze was, along with the reasons behind the price movement on March 8th, which took nickel from 25,000 a ton to over 100,000 a ton in less than a day. And this video is going to highlight nickel class and its relevance to this price move. And to recap the main reasons for the move, overall lack of investment in mining and refining infrastructure over the last decade, an increase in electric vehicle demand and overall nickel consumption. The war between Russia and Ukraine also played a pretty big role, as Russia supplies about 17% of the world's class 1 nickel. And finally, the nickel class distinction, and I think this played a larger part than what many of you may realize. So nickel is made up of two classes, like we talked about in the first video. Class 1 is anything 99.8% pure and above. It's used in manufacturing electric vehicles and stands to benefit from the continued development of the green initiative and the push for using battery operated over fossil fuels. Class 2 nickel is less pure, and the biggest demand for Class 2 comes from stainless steel. And while both Class 1 and Class 2 nickel demand have increased, Class 1 mining has not. And then to add to that, the largest Class 1 producer, Russia, like we just talked about, is in the middle of a war, and there's a lot of concern over whether they can keep up with production in the long term. And so we need to understand the London Metal Exchange and what its contract specifications are so we can understand more about how class distinction played a role in this move. So if you look closely at the specifications for the nickel futures contract, and the LME is where the nickel futures trade, you're going to see that physical nickel product is benchmarked to Class 1. And so this means if you're a producer of nickel and want to hedge your price risk, you want to lock in cash flow for your operation. You want to mitigate your price risk, so you sell futures on the LME. You're not going to be able to make delivery or use your physical nickel supply to offset your futures positions unless you have Class 1 nickel. And so Tsingshan was the biggest short seller on the London Metals Exchange during this move. And so why were they selling nickel futures? One, they produce nickel. So naturally, they want to protect themselves against lower nickel prices that could impact their ability to operate their business, meet shareholder targets, pay their bills, etc. Secondly, Tsingshan is working to develop a production process that would potentially enable low-cost Class 2 nickel, which they produce, to be used in electric vehicle batteries. And this could be bearish fundamentally for nickel in the long term. So should this technology advance, it would be a huge breakthrough in scaling affordable electric vehicle production. And Tsingshan's positions were so large that it nearly made them insolvent because they couldn't deliver their physical nickel to offset their positions because they have Class 2 nickel instead of Class 1. So they were one of the largest producers in the world, and they had all this nickel that didn't meet the exchange specifications, so they couldn't use it. And this meant that they were responsible for coming up with the money to pay for losses on their positions. This is also known as a margin call. And it worked out for them, however, because the London Metals Exchange canceled the trades and essentially bailed them out. It's probably worth noting that both the LME and Tsingshan are Chinese-owned companies. So what's next for nickel? And one possibility is vertical integration. And what do I mean by that? Vertical integration is the process where a company takes control or buys companies that contribute to one or more of their various stages in the production process and or distribution. So for example, a company that manufactures batteries may want to buy a company that produces the nickel that goes into the batteries they manufacture. And why would they want to do this? One is to control the supply chain. So they want to ensure they have access to the materials that make up their end product. Two is economies of scale. So by controlling the materials that make up the batteries, they can drastically improve their margins. And another area where we may see this is with automobile companies. So Tesla, for example, Elon Musk has stated numerous times that he'd be interested in a way to ensure he has adequate nickel supply in the long term. So, I mean, you could see a possible joint venture between possibly Tesla or Ford and a nickel mining company. If the economies work, this strategy makes a lot of sense. And regardless, I think we'll see an increase in technology and investment in the mining space. Um, the recent nickel spike and the war in Russia have brought to the forefront the need for increased stable nickel supply. Camellia Capital Management is an alternative asset manager with a focus on the commodity investment space. We manage a portfolio of energies, grains, metals, livestock, softs, and ESG related products on behalf of institutions. And feel free to reach out if you'd like to learn more about our approach to investing in nickel and also about including commodities in your overall portfolio.